All right, so it's 2:30, so this is our 7th class. We'll talk about the jobs report. Hopefully it won't take too much of the class. Hopefully you've already started writing your paper and you've got some sense of what you're going to focus in on. It was an interesting jobs report. We'll talk about it. Then we'll get into DC Cuts I, which is great topic. This is something you need to just permanently learn because it's powerful stuff. If you're getting any interview related to bonds, DC Cuts I is the way to go. Before we do that, we do have 2 meetings this week. The Professional Businesswomen Society, they have their meeting tomorrow at 5 o'clock. I'm not sure exactly. Is anyone in our class in that group? Any members of the Professional Businesswoman? I don't think it's just finance majors. Great group. Laura, are you in that group? Or someone was speaking up there. So you need to have something on your resume. So if you're not involved in an organization, we don't have the Pharma Finance this semester because that professor is out on a sabbatical. We do have the Investment Society. We start on Monday night, and there's the Zoom information. If you're unable to find the Zoom information, email me and I'll send it to you again, but it's out there on our Blackboard as an announcement. We'll start at 7:30. Normally we're at 8:45 when we're on campus because we need a classroom. But we're going to do 7:30 anytime we're going to be by Zoom. One thing I'm going to do, I was just talking to an alum at lunch today, and it's our alumni have some amazing things to tell us about how to be successful. And the world is changing, and it's getting involved with groups like the one I sent y'all from last week from Anthony and his group, the Businesswomen Association, the Investment Society. Get involved in something, if for no other reason, to get it on your resume. What employers are looking for is that you care about your degree outside of the classroom. If all you're doing is the classroom, you're going to have a tough time when it comes to interviews, and you're about to interview significantly here September, October. So join a group, get it on, and then get involved, at least go to the meetings. So when they ask you an interview, what does the Professional Businesswoman Society do? You can talk intelligently about what they do, or what does the Investment Society, our meeting Monday night. We're going to introduce all the officers and then tell you what the Investment Society does and why it's going to be powerful for your resume. So if you have other groups that are meeting, let me know and I'll put them out there. All right, let's talk to an employment report. Good news is it was a really big one. It was a really important one. It was really shocking. The bad news is the stock market didn't care all that much about it. The stock market, I was hoping the stock market would really react, but it didn't. But it's a very strange report. So here's the numbers. So I mean, this is pretty massive. They were expecting 740,000 jobs. The prior was 943. Now, they did adjust the prior up. And that's something you want to talk about in your paper. They don't adjust the unemployment rate. That one, once it's set, it's set. It's not a number that they go back and revise. But the payroll, that's an estimate. It's a bunch of algorithms, and so that number can change. The prior number can change. And so the prior number went up 100,000. So that's good. And possibly next month, that 235,000 that actually came out, maybe it's going to be revised up. Who knows? Now, why did they revise them up? Well, the payrolls is the survey they do of corporations, and they do it throughout the month. So they haven't finished the survey yet. They're still getting more numbers. They also have adjustments that they make. So one of the hardest adjustments they have in August, you may see this in some of the articles, is there's a seasonality adjustment to these numbers. You'll know what seasonality adjusted, right? You had that in your stats classes. So August is big because that's when everybody's coming back, for school. So there's seasonality, but then we have COVID, and there's some people who think, and you might see this in some articles, that the seasonality adjustments are somewhat messed up because of COVID, especially with the the second strain and a lot of debate about schools and masks and all that kind of stuff. I mean, it's amazing what's going on right now. So who knows if maybe they'll make an adjustment that their seasonality adjustment's just wrong. But these are amazing numbers. The 740 Excel, the consensus, that's an amazing number. That's a very, very, very high number. So normally it's 250 to 350. So they were expecting a very strong number. Why? Well, because we lost so many jobs last year. So a lot of students, especially with COVID, like showing the longer term graph to show how we've come out of COVID. So you can certainly find those graphs and put them into your paper. But what's really biggest about this number is that 235 is below the bottom range of the consensus. That's pretty wild. Now, then you jump to the unemployment rate. Well, it looks really good. It came out just as expected. Now, how in the world, and that's something you're going to have to explain into your paper, how in the world did we miss on the payrolls, but we met on the unemployment rates? So you have to understand these two rates. They're very, very different. The payroll is, you call corporations and ask them, it tends to be skewed toward larger companies. Unemployment rate, they call households. It's called the household survey. They call households. And I was in that survey a few years ago. The Department of Labor called me and asked me if I'd be willing to be part of the unemployment survey. And I said, of course I would. And they're very serious about their job. If you're not home, they're going to keep bugging you until they get you. And they would come and talk to me once a month. And they would ask the question, did you work last week? Yes or no? Did you want to work last week? And why is that important? This number right here, participation rate. Make sure you discuss the participation rate in your paper, and it's an extremely important number. But if I tell them I didn't work last week, and they say, well, did you want to work last week? And I say, no, I didn't want to. I'm not in the job market. Then I come out of the participation rate. I'm not participating in the market. If I tell them, no, I didn't work last week, however, I wanted to, if I could have gotten a job, I would have, then I affect the unemployment rate. Everybody understand that? The participation rate is what percentage of the population is actually an active participant in the labor market. If you're not an active participant, you come out of the number for unemployment rate. So it's possible you can have unemployment rate actually go up, more people are unemployed, not because people were losing their jobs, but because more people came back into the labor force and the participation rate went up. So what did we see here? The participation rate stayed the same, but they were actually expecting it to go up. Now the participation rate, you just have to talk about it in your paper. I give you credit for it as an other item, but you really, really do have to talk about it because it's been so critical. And if you do a longer term on this, you can see that COVID really affected it quite a bit. But there's other things going on. So you got the baby boomers retiring. You have, anybody know what COVID did to the baby boomers? Anybody read those news stories?
It was where they lost a bunch of their retire or 401ks and stuff.
Well, certainly the markets affected the 401ks. But some people in the late 60s, guess what they decided to do? They decided to retire, right? Yeah, Laura, they decided to retire. So a lot of people who weren't thinking about retirement, when COVID hit, they said, you know what? I'm done. I'm not working from home. I can't figure out Zoom unless I can get my grandkids to come over, and they can't come over. I'm not going to learn all this new technology stuff. I don't want to work from home. I'm retired. And that was it. They just shut it down. So that's going to have an impact. That's definitely, yeah, nurses and teachers. Some of them are retiring because it's like, boy, I don't need this stress this late in my life. I volunteered at a school. I won't tell you which school, but a school that was really quite challenged. And some of those teachers, I cannot imagine they switched to online. They were somewhere in the 1950s in their knowledge of technology. Hopefully the school helped them and get them up to snuff. But I mean, there's some teachers that probably say, I'm done. I'm not going to learn all this new stuff. So there is some impact there. So you could do a longer term graph for the participation rate. It got hit very, very hard in the 2008 crisis, and it's just been falling and falling and falling. But COVID definitely had an impact. There's some people who say that an unemployment rate is actually much higher than we think it is, because there's a lot of people who say they're out of the labor force just because they've given up, but they really do want to work. And so there are other unemployment rates you can see out there that look much higher than the 5.2%. So there's a lot of things you can talk here, but the participation rates are very, very important. Another very, very important number is the private payrolls. You always want to mention them. They were actually higher than the payrolls. How is that possible? Well, obviously the government must have cut jobs last month. Now, where can you go to get that data? If you go to the Department of Labor site, they'll actually give you a breakdown of this report by sector. And the only one they put on this report is manufacturing. Manufacturing used to be really, really important. It's now only about 15% of our economy, or 15, 20. So it's not as important. We're much more a service economy. I'm not sure why they put manufacturing on there. Manufacturing actually did well. Manufacturing's on the upper end. So that leads to a big, big question. How did manufacturing beat, and yet the 243 is below the bottom? What industry is kicking that number out? It could be travel and leisure, right? Because of COVID and people just aren't traveling anymore. I haven't been on a plane since January 2020. I usually fly 4 or 5 times a year. So, I don't know what airlines are like right now, if they're packed or not. Cruise lines were coming back, and now they're probably slowing down. So, which industry? Is it construction, home construction? That industry's been on fire, but there's been some issues with construction materials, some supply shocks. There's been some supply problems. Is it possible employment is being hit by these supply shocks? So that's your question. I don't know the answer to that. I sent you a bunch of articles, but see if you can figure out the answer to that question. What is the industry that most, is there one or two? Anybody done any research yet that they know, the answer to that? Think about your boss. You're trying to make your boss look like a genius. She goes in and talks to the CEO, and the CEO says, "Man, what happened with the employment report today?" He says, "Boy, we missed consensus by 500,000 jobs, but most of that was from just 2 industries." Well, now she sounds like a genius, and you made her sound like a genius, so you've done a good job. That's what I'm thinking. When I'm reading this is, can I find a student that can really explain what's going on with these numbers? So the top number, 235, is extremely important, 235,000. The 5.2 is important. The 243,000, extremely important. The next number, the 37,000, that one's probably not that important because it was pretty close to consensus, but you might look at the other industries and see, especially if there's some industry that cut a lot of jobs. The participation rate's extremely important, especially in the longer term context. And then you look at the numbers on inflation, and they look pretty bad as well. So 4.3, that's a pretty hefty jump in hourly earnings year over year. Now, this is another thing that got greatly distorted by COVID. I encourage you, go back and look at these inflation numbers for payroll last March and April. You'll be shocked. We saw some incredible jumps because of the government money spent. The $1,200 per person, that's for some reason caused a big distortion in the earnings numbers. So that number it usually is pretty flat, but it can jump around. So I definitely think because everybody's been talking about inflation, you might want to really do some discussion of these inflation numbers. You don't need to do both of them, but they're both. I mean, this is like the worst case scenario, right? The jobs added is below the bottom of the consensus, and the inflation numbers are above the top of the consensus. That's like the worst possible. Average work week's probably not that important this time. It's pretty close to consensus, but if you see an article that talks about it, that could be important. So what I'm grading on, what's real important, is that you don't just throw stuff in to talk about it, but you find stuff that's important and you explain it well. You give a good picture, a good color to the story, to understand what is going on here. Was this report really as bad as everybody said it was? Or is there some story that kind of offsets it? Should we be worried about these inflation numbers? Is the seasonality adjustment having some impact? So again, you're trying to make your boss look like a genius. What can you give to her so that she can say, hey, I understand this report. I know what's going on. All right, questions about this page here. So you can find more details than just what's on here, and the Department of Labor will have it. You can go to their site and you'll find a whole lot of extra detail. You don't get points for throwing stuff in just to throw it in, though. Make sure it actually helps answer some question. The last thing your boss wants is a massive table with 500 numbers on it. You say, hey, look, I found all these numbers. That's not going to be useful. So if you're going to pull in the Department of Labor by industry, and you're going to bring that massive report, then make sure you highlight the ones that you want your boss to really look at. All right. Better is maybe do it as a graph, convert it to a graph, and use some arrows to point out. Or maybe there's 10 industries, but 2 of them are the most important and the other 8 weren't. You could just do a bar graph of those 2 industries and then do everybody else to make a point of what's going on. You know, there's all different ways. So this is part of what you do as a finance major. For those that are finance majors, you got all this data. You got to find a way to summarize it into a chart so that you can tell the story as quickly and as efficiently as possible. All right. So start practicing that. So when you put this paper on the LinkedIn, you can point to it as an example of how you're able to really concisely explain what's going on. I'm not seeing any questions or hearing any questions. And then out on Blackboard, I gave you the markets. And what I did is I used FinViz, but I adjusted FinViz to put the actual numbers out there because FinViz can be a little bit confusing. FinViz shows the percentage change, not from the prior day close, but from the current day open. So it's a little confusing. So you want to talk about the market change from the prior day close. So that's what I put up here. So the S&P 500, how do you say it? It was flat, right? The S&P 500 was flat, falling just 1.5 points or 0.03%. But look at it throughout the day. Was it flat all day? So when did this report come out? I can never remember if it's San Antonio time versus, but I think it came out 8:30 New York time, right? And the market opened at 9:30. So the initial reaction was kind of bouncing around, but the initial reaction was pretty negative. You can say it fell about 15 points. Still not a big number, right? Throughout the day, it meandered around and it closed slightly down, but it was actually up there 30 minutes before close. Not a lot of story there, but how do you talk about it? So you're telling us, your boss, boy, we got this really bad employment report, and she's going to think, well, man, the market must be really off, and say, no, actually the market didn't react all that strongly. You would have thought you miss with high inflation. That sounds like the worst possible combination for the stock market. So this is the other thing you got to explain. Why didn't the stock market react more strongly? So you're trying to answer that question. There are other markets out there, tech stocks, they were actually up pretty decent, 0.2% or 32 points. Small company stocks were down quite a bit. So we've seen more of this. Growth stocks keep doing well, and small stocks and value stocks are doing poorly. Crude oil was down a bunch on Friday, but did that have anything whatsoever to do with an employment report? So what if it had nothing to do with the employment report? How would you put that in there? At the end of your paper, you say, you know what? Not driven by the employment report, but driven by X, Y, Z, whatever you want to talk about. It is important to note that oil prices fell over 1%, down over 75 cents on Friday. I don't think the jobs report influenced this. I think it had more to do with whatever, supply demand, some announcement that Biden made, or something going on in Saudi Arabia or OPEC or whatever. So why was oil, anybody know why oil prices were down 1% on Friday? Anybody figure that out? You don't have to talk about oil. You can leave it out entirely. You do have to talk about the S&P 500 and the 10-year Treasury. Those are required. The S&P 500 was flat. 10-year Treasury, we'll talk about that here in a second, It was down, interest rates were up. Anybody figured out the oil prices? That's a pretty good drop, right? 1%. All right, gold was up 1%. What in the world is going on there? That's pretty wild. Why is gold up 1% when oil is down 1%? That's interesting combination. Did gold react to the employment report? So what was that one thing in the employment report that gold might have really loved that we talked about?
The inflation.
Inflation, right. Is this gold reacting to inflation? It looked like it really did react to the employment report, didn't it? So the gold see those inflation numbers and they say, hey, you know what? Inflation is still a major issue. So gold jumps up, but 1% is a pretty good jump in gold. Silver was up as well, but why was silver up 3.6%? So who knows? There could have been some supply or demand kind of issue there, but I put silver in there just because it was one of the biggest movers on Friday. The dollar was flat. So that's interesting. You would have thought the dollar would have been down if we had inflationary numbers and weak economic numbers, but the dollar was pretty flat. So you don't have much there. And that's pretty unusual too, right? When gold is up a bunch, you expect the dollar to be down. So, you've got a little bit of a difficult task here. Your boss said you got to explain what's going on, but the markets aren't helping you out here. They're kind of all over the place. So how do you figure it out? You figure it out by reading a lot of articles. You could even Google things like, why was gold up on Friday? And see what comes up. Why was oil down on Friday? And see what comes up. All right. Those kind of things may find you something they may or may not. Now, I like this chart. You don't have to use it because Friday wasn't that big of a day, but this comes on FinViz. So this chart you may not use in this paper, but I just want to let you know this chart is out there because there are times when this chart is absolutely phenomenal. FinViz takes all the stocks in the S&P 500 and they color code them for the day. So dark red, like Best Buy, was down 2%. Target was down 0.6%. Amazon was up. So you see tech stocks actually did pretty well. Apple was up. Bank stocks were down. Retail stocks were kind of all over the place, but mainly down. Home Depot was up quite significantly, but Lowe's was down. Walmart was up. So you're kind of all over the place. I don't see any common thing here. Energy was down a bunch. That makes sense, right? So you can look at different in semiconductors. So tech looks strong. Industrials and energy were down. Why is that? Why are utilities down? I can tell you why utilities down. Interest rates were up. What are utilities? They're high dividend paying stocks. They're somewhat quasi bonds. They compete with treasuries. So utilities don't like higher interest rates. They tend to fall with higher interest rates. But also tech doesn't like high interest rates and they're actually up. So, you've got a whole mix of stuff going on here. So I'm not sure this chart really works well for Friday because it's just not. You should have seen this last year when we had the COVID sell-off. Almost this entire thing was dark red. Pretty shocking. It's a pretty incredible chart when almost everything is down. But everything's down but what? Amazon and Walmart, right? They're the big beneficiaries because everybody's going to be shopping from home. All right, interesting stuff. I love this chart. I don't know if y'all knew this chart even existed, but they have it, the green and red, but also the size of the company. So Apple's got the biggest box because they're the biggest company. So it's a really great chart. I don't know how they build it. It's pretty complicated, but they got it updated automatically for you. So I'd recommend on a really huge day, go find this chart, put it out there on your Facebook, and your friends will be impressed. It's a really impressive chart. I put Bitcoin in there. Bitcoin was up a bunch. So you might say, well, of course, Bitcoin was up because gold was up. Well, I don't know that's the case. My guess, if you went back and you could do this and do a correlation between Bitcoin and gold, I think you might be surprised the correlation is not as high as you might think. I might try that after this class today, but I don't know. Bitcoin and gold were up about the same amount. You think of Bitcoin as being digital gold. So maybe that's the case, but I don't know why Bitcoin is up. I'm not a real Bitcoin kind of guy, but so you have to look at the stories and see. Yeah, I saw that story, Anthony. What country was that? I forgot who that was.
I believe it was Venezuela. They bought 400, and then they plan on buying more after it becomes official.
El
Oh, there
Salvador.
was. I'm sorry. Go ahead, Brian.
Maybe it was El Salvador.
El Salvador. Yeah, there's a country that's actually recognizing. El Salvador recognizing Bitcoin as an actual currency.
As soon as they announced that it was their currency, it dropped like 10%.
Oh, really? So it didn't help. Yeah, it's interesting. Bitcoin. I'm trying to get Sergio to come talk to the Investment Society. He started a firm that does cryptocurrency and just kind of gives some sense of what's going on there. It's an interesting field. I can't make heads or tails of it yet to see what long term this is going to be. I think it's still somewhat of a messy thing. So your boss may not want that in the paper because it just might be kind of a messy thing to talk about. All right, but you do have to talk about the 10-year Treasury. What did the 10-year Treasury do? It was up 2.8 basis points, closing at 1.322%. So the price was down. It definitely reacted to the report. So what would you expect? So you had a weak report with inflation. Typically, you would expect the stock market off 1 or 2% and Treasuries off. So we did get it was true that the stock market was down and Treasuries were down, and that's what you expect when you have inflationary news. However, the stock market was not down that much and tech stocks were up. So the other thing you have to realize, we are in the middle of earnings season. So it's possible some firm reported earnings on Friday that kind of drove markets. I haven't looked at that. You might look into that. That's paper 2, right? We're going to talk about earnings. So not a good day for Treasuries, not a horrible day, right? We said that one standard deviation is 6.5 basis points. It's only 2.8 basis points. So it's not a huge day. But it was a down day for Treasuries. So I wish markets had reacted more. I got the employment report I wanted. It was a really huge employment report, really big data. But the markets, even the Treasuries, reacted negatively, but not that negatively. All right, any questions about paper 1? You're really on your own now, unless you can call me and talk to me about it. You know that you have those example papers out there. You can't copy and paste those, but you can certainly use that format of the 2 columns, thin borders, a lot of bolding, well titled charts, short paragraphs, keep your paragraphs short, those type of things. Now I'm still waiting for students to reply to my email on your availability. I've only gotten 28 so far, and I need the whole class or pretty close to the whole class, mainly because I want to get you in the group of 6 to talk about paper 1. So try to get your score as high as possible, and even more importantly, get you writing these papers more professionally. The student I had lunch with today, he works with a lot of college students, and he's like, Professor, you ask a simple question, they're like, I don't know where even to start. I don't know what I'm supposed to do. And he says there's a frustration with corporate America that college students, you ask them to do something, and they're expecting someone to tell them, well, do this first, then do this, then do this. And corporate America is like, no, figure it out on your own. Critical thinking. All right. Giselle, I'm not sure. I mean, it's the due date's out there, right? October, or whatever. It's on the, is that what you're asking, what the due date is? So I've given you about a month to write the paper, even though in real life you only have about 30 minutes. So, you got plenty of time. So other questions on this paper? I kind of, I generally like a huge market day, but I kind of like this paper it's a little more challenging for you to explain it. So you're going to have to use some more critical thinking here. Find some good articles, ask some good questions on Google, try to find some stuff, try to see if you can find that 1 or 2 things that really is the most important to explain this. All right, I'm not seeing any other questions. So Anthony, you have a question?
Yes, sir. You said do not follow the format of the examples at all, correct? correct?
No, you can use that format, the 2 columns. Yeah, I actually recommend make it look as much like a professional journal as possible. Just don't write your paper by copying and pasting theirs and just editing their text. That really won't work, right? Because they were writing for a different day. But some students do that, and I see almost the exact same language. They'll use the exact same language and change the word down to up, but it doesn't make sense in the context that they copied it from. So, write your own paper from scratch, but you can take one of those papers and load it, delete everything, and then write yours in that format if you're not sure how to do that 2 columns. I don't count out for formatting, but I will tell you 1 column, double space. If your goal is to never get hired in a job in finance, then use that format. It looks so unprofessional. It looks like a college paper. Single space, 2 columns, thin margins, short paragraphs. That's the other thing. Students write paragraphs that are way, way too long. Keep the paragraphs short. Graphics, well-labeled graphics. Make it look as professional as you possibly can. And that's why I like that format, because it does look like something you would publish. It also doesn't just look like the format you'd see in a professional journal. It also looks a lot like the format you see with street research, JP Morgan or Goldman Sachs. So start putting together a format you're proud to put your name onto. So the formatting, I do think, is somewhat important. The story is more important, but if you write your paper and you only have 3 paragraphs, you may be writing really good stuff, but it's going to be horrible to read when you have those long paragraphs. I've had students turn in 3-4 page papers that are all 1 paragraph, and it's just like, no one wants to read that. It's horrible to read that. So you are communicating as well as you can and using the format to help you. Use a lot of bolding, good titles. All right. So blow me away, impress me with how you communicate. This is a huge part of finance. It really, really is. How good of a job you do in communicating. All right. So we've done the major asset classes. So what we want to do, we did cash last class, right? So we're going to start here with fixed income. Any questions? So y'all see your exam answer. What is a portfolio? 3 questions asked. Why are you investing? Focusing on horizon. What are you going to invest in? That's that parsimony. And then how are you going to implement and do it yourself? Hire someone outside? How tactical are you going to be? So now we're getting into that what question. And last class we did cash and cash equivalents. Now we're going to get into my favorite asset class, which is fixed income. All right, so fixed income, we have DC cuts I. And anyone off the top of their head without looking, give me the DC cuts I. Anybody learned it yet? Anthony, you remember all 6, 7 of them? DC cuts, is it 7? Anybody do it off the top of your head?
Is it dividends or debit?
Not dividends, no, not for bonds.
I know duration and convexity.
Duration, convexity, those are the ones I had you read about. All right, so it's duration, convexity, credit, US versus non-US, taxes, structure, the one we'll cover the least time on, but structure is about half of that Favosi book I showed y'all last class. Structure and inflation. All right, DC cuts I. I cannot think of another letter. I've asked, I have a lot of friends that manage fixed income. All my friends from Victory Capital, they're mainly almost all fixed income people. I can't think of another category. So if you can learn this DC cuts I about any question you get in an interview on fixed income, you're going to be able to cover it with DC cuts I. All right, so let's start with duration. All right, remember what you got to do. You have to define it, discuss the subclass asset classes, and talk strategy. All right, define sub-asset classes strategy. Now I did it out of order here. I gave the sub-asset classes first and then the definitions. Let's start with the definition. I don't know if any of y'all Googled this. If you Googled it, you probably found things like Macaulay duration and modified duration, effective duration. Effective duration is the most advanced one, the most difficult one. Spread duration. I don't know if any of y'all looked up spread duration. A lot of terms. In this class, I'm going to show you how to calculate Macaulay duration and modified duration. It's actually a very easy number to calculate. So you do not want to graduate from college as a finance major and not know how to calculate duration. All right, that's one of those basic things everybody knows how to do. So make sure in this class you're comfortable with how to calculate duration. This is the only class that actually calculate duration in. So what is duration? It's the weighted average time to maturity. All right, so that first term, weighted average, well, you're going to do a weighted average. You have to know what is my weight. And the weight you're going to use are the discounted cash flows as your weights. All right, so I'm going to actually show you how to do that when we price a bond, because when we price a bond, we're going to have all those discounted cash flows. And we'll just multiply those by the time and divide it by the total, and we'll get the duration. And what does that tell you? Well, duration is not the same as maturity. A 10-year bond has a maturity of 10 years, but it doesn't have a duration of 10 years. Why? Because a 10-year bond is going to pay coupons, pay interest every 6 months. So what duration is saying, well, you know what? You're getting all your money back, your maturity in 10 years, but every 6 months, you're getting a 3% coupon. So you're getting cash flows before the end of 10 years. So what duration is saying is, well, some of your cash is coming in 6 months, some's coming in a year, some's coming in a year and a half, some's coming in 2 years. So my duration might only be 8.7 years. It's not going to be 10 years, and maturity is 10 years, but the duration is going to be shorter. And duration is almost always, not always, but duration is almost always shorter than maturity. A 30-year treasury might have a duration of like 21 years. Why? Because a couple of things. Here's how you can really understand this, and we'll see this when we do the pricing of the bond. Y'all remember what present value impact? You remember when y'all did present values? You remember the impact if you go out 30 years versus 5 years? When you divide by 1 plus n to the 30th, y'all remember that? 30 years out, it's going to have a huge impact. 5 years out, not such a big impact. So the further you go out in maturity, the less that maturity value has an impact on duration, and those coupons have a bigger impact. So a 30-year bond is going to have a duration that's much further away from maturity than a 10-year bond. So a 30-year bond might have a duration of, say, 21 years. A 10-year bond might have a duration of 9 years. A 2-year bond might have a duration of 1.95 years. All right, so the closer you get in time, the more the maturity and the duration look the same. Why? Because that maturity value, when you get all your principal back, that's the biggest cash flow, right? And so that's going to have the biggest impact. We'll see this mathematically. I'm going to show you how to calculate it. But duration is the weighted average time to maturity using discounted cash flows. Duration is also the measure of price risk. Remember when we talk about cash versus bonds? Cash has very low price risk, but high reinvestment risk. Bonds have varying degrees of price risk and varying degrees of reinvestment risk. Duration measures that price risk only. It doesn't measure, we don't really have a measure for reinvestment risk. We just have a measure of price risk or interest rate risk. I use those interchangeably. What does that mean? How much of the price of your bond is going to change when interest rates change? Here's the formula you can use. The percentage change in the price of the bond is about minus duration times the change in interest rates or change in yields. All right. Now I told you later in class, I'm going to give you the formula for duration. This is not the formula for duration. This is the formula where you use duration to figure out how sensitive a bond price is to changes in interest rates. All right. If you graduate not knowing this formula, you're in a lot of trouble. All right. I'm going to try to tell you there's certain things every finance major should know. In this formula right here, every finance major should know that. Now, later, I'm going to give you the formula for duration, My guess is probably only about 10% of undergraduate students know that formula. Every finance student should know this formula. All right. Why does it start with a minus sign? Well, because when interest rates rise, bond prices fall. All right. I'm going to come back to the three categories. Let's just give an example here. So let's say a bond has a duration of 5 years. What would you expect if interest rates rose 100 basis points? Remember, 100 basis points is 1%. So look at the way I write it. Minus duration, my duration is positive. Can you have negative duration? Yes, there are bonds with negative duration. There are actually bonds out there that go up in price when interest rates rise, and they're pretty rare, but they do exist. I own a bond like that. I have a bond that is short treasuries. So it's an exchange traded fund that actually is shorting the treasury market. So interest rates rise, treasuries fall, my mutual fund goes up, right? But most bonds have positive duration. So minus duration, duration's +5, times the change in yields, yields rose 1%. You do that formula, you get -5%. So if you have a 5-year duration bond and interest rates rise 100 basis points, you would expect that bond to fall 5% in price. Questions on that? This is really, really important. You should have seen this in other classes. You'll definitely see this in my risk management class. If you take the fixed income class, which I highly recommend, whether Dr. Baynot or John Toohey's teaching it, either one, strongly recommend it. They'll go in a lot more detail about duration. You saw in the Fobosi book that he spent, a whole chapter just talking about bonds and their sensitivity interest rates, and duration's a big part of that. All right, let me pick on someone. I won't call a name, maybe we'll get a volunteer. Let's say you have a bond with a duration. Just a second, I'm gonna type it out. You have a bond with a duration of 7 years and rates fall 200 basis points. What would you expect that bond's price to do? Anybody want to take that? Colin, Blake, Brian, any takers on that?
Go up 14%.
You go up 14%. Good job, Brian. You did that top of your head, Brian. There's about 50% of finance majors that takes them like 40 minutes to do. So you're getting good with basis points. Very, very good. Yeah, some students is like, this basis point thing, I just can't handle it. But Brian knew off the top of his head, 200 basis points, that's 0.02. 0.02 times 7 is 14%. Interest rates fell. So minus plus 7 times minus 0.02 gives you positive 14. So very, very good. Questions on that? This is really, really very, 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 very important. All right. So that's the definition of duration. You want to get that definition in there. If you want to impress me on the exam, then go do some Wikipedia searches and impress me. There are 3 durations out there, at least, well, 4, I guess. So there's Macaulay duration, which we never use. There's modified duration, which is Macaulay duration fixed for a mistake. I really wish they had fixed Macaulay's mistake and just called it Macaulay duration. The poor guy came up with something great, and then we don't use it because he had one math error. There's effective duration, which is by far the most complicated, and we'll talk about effective duration when we get to convexity. And then there's spread duration, which did not exist when I was working. Spread duration is a recent thing. I still don't quite see the purpose of it. I was talking to my buddies at Victory Capital, and they still haven't convinced me there's anything with spread duration, but read about spread duration. So there's those 4. Effective is the one that's by far the most difficult. I don't know if they handle effective duration in the fixed income class. I do know in the Fabozzi book, he spends quite a bit of time with it. It's a very complicated formula. Now, effective duration and modified duration are exactly the same for treasuries and most corporates. So we'll talk about when we get into structured debt, when it makes a difference, all right? Now, why am I saying all this? I want to make sure you know we're scratching the surface. All right, y'all can see this is the tip of the iceberg, and the iceberg goes about 20,000 feet below the water. All right, so this is a good way to test should you be a finance major or not. If you're going, man, I can't wait to learn all this, then you're a finance major. If you're thinking, man, there's just too much. I'm just sick of all this. So if ignorance makes you excited, then you're in the right field. If ignorance just irritates you and you're just like, I'm sick of all this, then you're in the wrong field. All right. So I'm just trying to whet your appetite. You can go so deep in this topic. It's just an amazing topic. All right. Now let's talk about the sub-asset classes. So Vanguard is a very famous firm. It's the second largest investment firm in the world. Started by Jack Bogle or John Bogle, one of my favorite people. Unfortunately, he passed away a few years ago. But Vanguard came up with these categories. So it was Vanguard who came up with the categories of short-term, intermediate term, and long-term. Short-term has low duration. Now, short-term is 1 year or more. So it's after cash, right? We don't consider cash to be short duration. The cash is just cash. So short-term is like 1 year to like 3 year duration. Intermediate term is maybe 4 to 6 year duration, and the long-term over 6. Now, there's no hard and fast rules on this. If you're getting up, so a good example is the Barclays aggregate. That's the most famous. Used to be the Lehman's aggregate, but Lehman went out of business, so Barclays bought it. So the Barclays aggregate is that biggest bond benchmark or index. Historically, I don't know what it is today, but historically, it's had a duration right around 4.5 to 5 years. So if you looked at the entire bond portfolio, not including cash, but the entire bond portfolio, the typical durations in that 4.5 to 5 years. I wish I could see what it is today, but I don't have access to Bloomberg and haven't looked in a while, so I don't know. One thing you have to realize, and boy, if you can understand this off the top of your head, you're in good shape. But when interest rates are low, like right now, duration tends to be much longer. If you think about it, the biggest impact on duration is that maturity value. And when interest rates are low, what happens to the weight of that maturity value? It's going to be much higher, right? Because the present value of $1,000 30 years from now is going to be much higher. Your discount rate's 2% versus 5%. So when interest rates are low, duration is higher. When interest rates are high, duration is low. You don't need to know that for this class, but it's a cool thing to know. They do ask that on the C of A exam. So if you're taking a C of A exam, you have to understand that. I used to have to draw it out, but now my brain has gotten a lot more comfortable with it. All right, so you have so if you go to Vanguard or pretty much any major mutual fund, they will have short-term bond funds, intermediate-term bond funds, and long-term bond funds. Short-term bond funds, when interest rates rise and fall, their price won't move that much. Long-term bond funds, when interest rates rise and fall, their price is going to move a bunch. All right, so higher duration, more risk. Lower duration, less risk. And what kind of risk? We're talking specifically about price risk. Short-term bonds are not as sensitive to changes in interest rates as long-term bonds. Okay, questions on that? We're covering some really hefty stuff here, really important stuff. It's sinking in. Hopefully everybody's, I'm looking at the same 4 people. Let me switch over. Everybody's good. Avi, Luke, Ashley, Farah, you're all good. Carlos, you look like you're getting it. You got I got it figured out, professor look on your face. All right. Remember what's the third thing? Strategy. What's the strategy? Your boss expects interest rates to rise. What are you going to do? You're going to shorten duration. And that's the term, shorten. We don't say reduce. For some reason, we say shorten. We shorten duration or we lengthen duration. So if your boss expects interest rates to rise, you would want to shorten duration so that your bond, you don't have so much a huge loss on your portfolio. If your boss expects rates to fall, you would want to lengthen duration. Oops, sorry. Let's see if I can get this to work. There it is. All right, so I gave you a link in the class notes. This is a really great site that shows you treasury rates. Right now, 1 month rates. Let me see if I can blow this. Can y'all, hopefully, if I'm talking about something you are not seeing, let me know. So right now, short-term rates, this is as of, well, it says today, I guess, boy, they publish this pretty fast, don't they? 1 month rates are not 4%, are they? That's not 4%. What is that? That's 4 basis points. That's 0.04%. The 30-year is at a little below 2%. What did interest rates do today? They shot up pretty dramatically, didn't they? Up 5 basis points. Y'all see that? The 30-year is up 5 basis points today. So what did the 30-year bond do today? It fell. And not only did it fall, it fell a bunch, right? Because what does a 30-year treasury have? A lot of duration. All right. So the 30-year treasury, the yield was up 5 basis points. The 30-year treasury has about 20-year duration. So you can do that math. So the 30 years down, what, maybe 1% today? I don't know. I can't do the math. Someone do the math for me and let me know. So you take what? Minus 20 times 0.0005 and see what you get. Is that 0.1% or 1%? I'm not sure, but the 30-year treasury being down today. 4 basis points on the 20, 5 basis points on the 10, and short-term, almost no move whatsoever. All right. What else can we say about this? Well, something you should do as a finance major, you can go get this data. The way you get this data, if you want to get it into Excel, in Google, just type H15, and H15 will bring up the St. Louis Fed. And when you click on that, they have the ability to bring in historical interest rates on a daily basis back to 1962. You can get a lot of data. So what you want to know is the other thing is really important is how steep is the yield curve. And the way I learned how to do steepness on the yield curve is to compare the 10-year to the 2-year or the 10-year to the 1-year. You can do it either direction. I should have done it today. Maybe I'll do it next class. But if you bring in that data and look at that over time, what you want to see is what's the normal relationship. And it has been a while since I've done this, so I can't put it. It's somewhere around 70, 80 basis points. So a normal curve, normally the 10-year is about 0.7 above the 1 year. So the 1 year is at 3%, expect the 10-year to be like 3.7. So right now we have a fairly steep yield curve. It's not as steep as, we've had some really steep yield curves, but fairly steep yield curve. I don't know how many of y'all are taking money in banking right now, but what does your money in banking class tell you about steep yield curves? Anybody remember that? What is a steep yield curve when the longer term rates are much higher than the shorter term rates? Is that recession, strong growth, inflation? What's the bond market telling you? No takers on that? Let's go back to a recession. So here's 2007. What do you notice about 2-year and the 10-year now? The 10-year is lower than the 2-year. Anybody know what that's called? Are y'all taking money in banking this semester or you took it last semester? Where are y'all?
I'm taking it this semester.
I'm taking it this semester.
All right, this is a great time to take money in banking, right? You got Powell out there trying to make decisions with COVID and inflation and unemployment and all this kind of stuff. Boy, this is like, I'm not qualified to teach money and banking, but boy, this would be an exciting time to teach it. So what is your money and banking professor telling you? What is this yield curve called? Anybody remember? The 2 years greater than 10-year, it's called a, no takers? Someone's got to know. Inverted yield curve, right? You remember that? Inverted yield curve, longer rates are higher than shorter rates. When do we have an inverted yield curve? Well, what happened in 2008? We had a massive recession. What is the bond market really good at predicting? Recessions. We've never had a recession without an inverted yield curve. The bond market is really good. Now, sometimes we have inverted yield curves without a recession. So this is something you should do. Bring in these rates and actually take the 10-year yield and subtract the 2-year and just look at it over time. And one thing you'll notice is the difference goes negative before every recession. It's an amazing thing. It's really an amazing thing. So what about this last year? So 2020. Go. Not quite inverted, is it? But it was getting there. We go back to 2019. It's getting close though, isn't it? Here's 258, 260, somewhere in here it inverts. Now you might say, this is why these bond people are really smart. So in 2019, the bond market was predicting a recession. Did they know COVID was coming? You think the bond market's that smart? How did the bond market know we're going to have a recession even before anyone was talking about COVID? That's pretty impressive, isn't it? Because most people say, well, we had a recession in 2020, but that's because of COVID. The bond market says, no, we were expecting one anyway. Now, what do you call this yield curve? This one's not inverted. Well, that might be somewhere in here. I'm pretty sure it is somewhere in here. Here it is. There it's inverted. There it's inverted. You'll see that inversion, right? But what do you call this one? You may know the term for that. Y'all heard the term a flat yield curve? A flat yield curve and inverted yield curve. That's when the bond market's telling you economic growth is really weak. We're not going to have a good economy in the next year or two. Probably going to have a recession. So inverted definitely tells you recession's coming. Flat tells you maybe not a recession, but it's not going to be robust growth. It's not going to be strong growth. All right, so without using my name, your next money and banking class, first you need to go run the numbers yourself and figure out what the historical numbers are. And then when do you have your money and banking class? Is it after this class? Tuesday, Thursdays? So I don't know your money and banking professors. I knew one lady that taught it, but I don't know if she's still at UTSA or not. But I heard we got a new money and banking professor that's really very good, but I don't really know. But the question, so this yield curve, especially today, let me do current. I should have just done current. If y'all could see what I'm seeing, you understand why I'm having so much trouble, because y'all's pictures are right in the way. So your question for your money and banking professor is, Professor, why is the Treasury yield curve so steep right now? That's the word we use, steep yield curve. What is the steep yield curve telling you? The bond market expects either strong economic growth or inflation. You have strong economic growth, Powell's going to increase short-term rates, and the long-term treasuries are expecting that, and so they're much higher than short-term. Or if you have inflation, the Fed's going to increase short-term rates, all right? So an inverted yield curve, that means you're expecting a recession. A flat yield curve, you're expecting weak growth. A normal yield curve, you're just expecting normal. That's when the 10-year is like 70 basis points above the 2 or whatever it is now. I really haven't looked at it in a few months. A steep yield curve means you're expecting strong economic growth or inflation, right? That's something else you should know without graduating, before you graduate. All right, that's one of the things every finance major knows that. So ask your money making professor. Don't tell them, don't give them my name. I don't want to get in trouble with other professors. And Dr. LaRusso, I've known her for a few years. Yeah. Just ask them the question and see what they say. Why is the yield curve so steep? They're going to probably tell you either we're expecting, they may give you the inflation number. Yield curves are steep when we're expecting inflation, but they may say, hey, we're coming out of COVID. We're expecting much stronger economic growth going forward. So the yield curve is reflecting that. All right. But before you ask her that question, go out and get these numbers and take the 10-year minus the 2-year, look at what it's been historically. And I'll try to do that beginning next class just so we can see what it looks like. All right. Any questions on that? Stop sharing that. Yeah, money and banking might be the most important class you're taking right now because that's what everybody's talking about. So for your interviews, you need to get as much out of that class as you can. That's the kind of class. Hopefully, you're doing a lot of current. You're talking about Powell. You're talking about what the Treasury is doing, the spending, the deficits, the U.S. dollar, gold, yield curves, all that kind of stuff. What is the market telling us? And that's part of your paper one. What is the market telling us is going on? The market's not always right, but it's always smart. It always has something important to say. Even when it's wrong, it has something important to say. So that's what you're trying to figure out. So take this class with your money and banking together to try to put all these puzzle pieces together so you can talk intelligently about what's going on. All right, so that's it for duration. Let me give you another scenario. Your boss expects a recession next year. What do you think you want to do with duration if your boss expects a recession next year? So the first question is, what do interest rates usually do going into a recession? Did it usually rise or fall going into recession? What would you think? What does the Fed do in a recession? Do they raise rates or cut rates?
They'll cut them.
Cut rates. So interest rates should fall. So if your boss doesn't say what she thinks about interest rates, but she says, I expect a recession next year, then you'll say, well, that probably means interest rates are going to fall. The Fed's going to be cutting rates. So we should probably increase our duration. Lock in rates today. That 30-year bond at 2% looks pretty terrible, but if you expect that rate to fall down to 1%, then lock in the 2% now. You got it locked in. You have the recession. You'll make 10, 15, 20% on the 30-year bond. You can sell it with the gain and invest somewhere else. So we're going to see this when we talk about credit. There's a close tie between treasury rates and recessions. We generally expect treasury rates to fall during recessions and to rise during strong economic times. Now, there are some exceptions to that, and we'll talk about that a little bit later. All right. So shorten duration, lengthen. Those are the terms used. I don't know who picked these terms. It wasn't me. This was before I was even born, probably. So shorten duration or lengthen duration. I don't know why it's cut duration, reduce duration, increase duration. If you want to sound smart in interview, you use the word shorten and lengthen for some reason. Somebody named Bob or Betty came up with these terms back in 1912 or something. Who knows? It just stuck. Are any final questions or any questions on duration? This is something that has to go into your long-term memory. All right, you have to know this. This is not one of those things you learn it in the class and forget it and go into your next class. All right, so I don't know how to emphasize it more strongly than you need to know duration. Now, bonds have duration. You might be interested that other assets have durations. Stocks have durations. Real estate has duration. When I was at UTSA, I read an article on real estate duration. I really loved it. So I implemented it at UTSA, and the entire real estate company started calculating duration on their real estate. It's like, wow, this is pretty cool. However, stocks and real estate, their durations are not as reliable. Stocks have duration, but they're much more sensitive to other things besides interest rates. So in 2008, interest rates fell. Treasuries rallied up 15, 20, 30%. Stocks have a duration, but interest rates fell in 2008 and stock prices did not rise in 2008. They actually dropped, and that's because other things drive stocks. So every asset has some duration. Every asset has some sensitivity to interest rates, but bonds, especially treasuries, are the most sensitive. And so they will have the biggest exposure. All right. So don't limit yourself to duration just to bonds. It can be other assets. In fact, gold probably has a duration. Yeah, definitely mortgages. We're going to talk about mortgages next, Anthony. So if you're in that market, we're going to definitely get into that market next because that changes the whole equation. All right, y'all ready for me to blow your mind? Y'all ready for convexity? All right, so I'm not supposed to show this to you. You're not supposed to have this topic. It's too advanced. I don't believe that. I do think you can handle it, and students in the past have been able to handle it, but it's a quite complex topic. So convexity is like the second order sensitivity of bonds to interest rates. All right, so duration is like the first derivative, convexity is the second derivative. Convexity is like the change in duration. And so one of my former students created this website, which I thought was pretty cool. He built it with Python. This is an undergraduate student who had never taken a Python class in his life. He taught himself. He saw me, I showed a spreadsheet, and the spreadsheet he shows is out there on Blackboard if you want to look at it. He looked at that spreadsheet, he converted the whole thing to this website. So let me share that with you if I can. Boy. Let me stop sharing. Find that website. There it is. All right, so he built this website, and it's a really, really cool website. So I can give a 10-year bond with a coupon of 5% and a yield of 5%. You already know the price of that bond is going to be $1,000. Right, we're going to study that later. It has a duration of 7. So there's that 10. Well, what's the 10-year treasury today? 1.3. So the 10-year treasury today, because interest rates are so low, you see how the duration went up when interest rates fell? So the 10-year treasury has a duration of 9.35 years. If I do a 30-year bond, what do we see that was at 2%? 30-year bond has a duration of about 22 years. It's not 30 years. Why? Because you're getting all those coupons. What do you think that duration is going to do if the coupon goes to 6%? Is it going to rise or fall? See if you are starting to get the intuition here. Interest rates go up. What happens to duration?
It falls.
Falls quite a bit. Look at that. It fell almost 10 years. So it's very, very sensitive. All right. Now, let's do a 0 coupon 30-year. Look at this convexity. What in the world does that mean? I'm going to show you the formula for it, but it's 914.36. That's a huge number. The duration's essentially 30 years. This is the modified duration adjustment we're making. All right. It doesn't pay any cash flow. So essentially all of the cash comes in 30 years. So the Macaulay duration is 30 years. The modified duration is 29.7 years. Right, so a 0, you know what a 0 coupon bond is, right? It doesn't pay any coupons at all. You pay $550 today, and in 30 years they give you $1,000. That's what a 0 coupon bond is. Compare that to a 5-year bond. Remember 914, all right? That duration, like convexity, a 5-year bond with a 2-year coupon, its convexity is only 27. So the question is, do we want convexity? Anybody have any ideas from your reading? Do you rather have more convexity or less convexity? Guesses, we wanted less duration for risk, right? More duration means you're more exposed to interest rates unless you think rates are going to fall. But what about convexity? Would you rather have higher convexity or lower convexity? Any guesses on that? Well, let me
It
show
says
you.
that you, oh, sorry.
Go ahead.
The notes say that you want to buy bonds with high positive convexity.
High positive, exactly. And this chart shows you why, doesn't it? This blue line is how that 30-year treasury would have moved if duration's all we needed. The green line is how the price actually moved. And this bond has positive duration. How can you tell? Because the actual price is well above the duration line, all right? Duration is just a straight line. Don't you like everything in the green more than in the blue? Your price is always higher, right? So it's always good. So this bond has high positive convexity. And that always helps you. When interest rates fall, the price shoots up even more than you would expect. When rates rise, the price doesn't fall as much. So positive convexity is wonderful. If you look at a 5-year bond, you almost can't tell the difference, right? Duration is good enough. Convexity really doesn't add much, especially when interest rates rise or fall 2%. You can see duration and convexity give you almost the exact same answer. It's only off by about $5 or $6. But 30 years, zero coupon, it makes a big difference. If you do duration, you think this bond's going to rise from $550 up to $1,300. But if you ignore convexity, but if you include convexity, it actually goes up to $1,900. Long treasuries in a recession are glorious. They're up like 30, 35%. They're wonderful. Why? Because they have long duration and they have a bunch of convexity. So the price goes up because they're long duration and you get the kick of the convexity. It's the most wonderful thing in the world. They're wonderful bonds. 30-year treasuries did tremendously well in 2008. They're like the place to be. They may have been the highest performing asset that was out there. Just a tremendous thing, right? Now, I'm not asking you to calculate these numbers. If you go to the Excel spreadsheet I put out there and look at the formula, it is a messy formula. Very, very difficult formula. You're essentially doing the derivative, but doing it by hand with the formula. There's more than one convexity formula. It's because convexity changes as convexity changes and as duration changes. So it's just a moving target. It's really hard to get your hands around it. And so for 30-year treasuries, if rates only fall like 1% or rise 1%, duration and convexity give you about the same answer. Now, this is really key, and this will set us up for next class. When interest rates change a bunch, convexity gets really important. If interest rates don't change much, convexity is not important. But when interest rates change a bunch, y'all agree, it makes a big difference, doesn't it? Now, what we're going to talk about with convexity is that there are bonds that have negative convexity. So Tiana said we want high positive convexity. So what does that tell us about bonds with negative convexity? You better pay me money to buy those things. You're going to have to pay me more money. You're going to have to induce me to buy those bonds. Because what's that line going to do? It's going to come down and go below the blue line.
So those are like mortgage-backed securities, right?
Right, mortgage-backed securities. Exactly. That's what we're going to get into. So Anthony, if you deal with mortgages, we're going to talk about mortgage-backed securities. Mortgage-backed securities have negative convexity. Not necessarily junk bonds. Okay, Anthony, good point. We're going to talk about junk bonds. When we talk about junk bonds, Anthony, you might think duration and convexity important. Most junk bond investors ignore duration and convexity. And we'll talk about why, but it's a good point. It's a good question. Do you care that a junk bond has a duration of 5 years? So we'll get into that when we talk about credit. So right now in this part, we're going to talk mainly treasuries and mortgages. So when we get in next class, we got 1 minute. What's the special thing about mortgages that makes them so difficult? So Donald Trump, when he was president, he talked about going out there and buying all those 30-year treasuries back at $1,000. Could he have done that? He bought these treasuries paying 6% and the current yields were 2%. Could Donald Trump have bought those treasuries back at $1,000? No way. It would have been breaking the law. People say, you know, I got a bond paying 6%. You're not going to buy it for $1,000. You can pay me $1,600 and I'll sell it. But Donald Trump would say, hey, we'll just pay off all the government debt at par. You can't do that with the treasury, but can you do that with a mortgage? Absolutely. If you want to pay off your mortgage at par, you might have a mortgage at 7% and interest rates are 2%. If you want to pay off that mortgage at par, you can do it. So we're going to talk about prepayment risk and extension risk and what that does to duration and convexity next class. All right. See how exciting this stuff is getting.